Bottom line, what we've actually witnessed here is an officially planned foreign exchange market intervention to overturn an increasingly illiquid but deliverable, unbacked, long gold, short dollar, over-the-counter position. So if you were ever going to do something like this, you couldn't have picked a better time.
Upon the breakout, gold's going to make a new all-time high.
Gold-backed ETFs seeing inflows of over $5 billion.
$0.8 trillion gold market.
Why are we the only guys that seem to understand this? Makes your head spin.
Hey, welcome to Live from the Vault. As you can see, I'm out of the vault today. As you can imagine, it's been a very busy and hectic a couple of weeks. We're excited. You know, our community is growing very fast, and we thank you. Keep spreading the word. There's a lot to talk about, of course. I'm sure you're excited to hear what Andrew Maguire has to say. So we're going to head over to Talking Gold in just a second. You're not going to want to miss this episode. We've got some incredible insights into what's happening right now in the precious metals markets. And so with that, buckle up. Just before we get started, I want to remind everyone, please keep spreading the word about this channel by liking, sharing, and hit that subscribe button. Not now, but hit it right now. And then click on the bell if you'd like to be notified in real time as these episodes go live. So with that, let's go right into it. Head over to the UK and Talking Gold with the one and only Mr. Andrew Maguire.
Yes, Shane, and this is actually quite a special one, actually. But yes, of course, elephant in the room. Let's start by putting this August holiday thin market action that culminated on Monday into perspective. I mean, obviously, that is the major focus. This is where all the questions are coming in. Bottom line, what we've actually witnessed here is an officially planned foreign exchange market intervention to overturn an increasingly illiquid but deliverable, unbacked, long gold, short dollar, over-the-counter position as the window into Basel III compliance closes just before we head into season 2. So if you were ever going to do something like this, you couldn't have picked a better time with Asian markets closed, some of the Asian markets closed, and really most people I know on their trading desks, they're just not there. We've got most trading desks actually skeleton staff run by juniors. And of course, what are you going to do at 1 o'clock in the morning? Obviously bearing in mind that most of Europe, most of this happened in the over-the-counter market. So really most of it actually, which is what most people haven't picked up on yet. But what I want to do is explain why and who instigated this surgical chart painted action. I mean, it's pretty obvious. And I'm going to put that into context with the larger picture, with a particular focus on the wholesale footprints underlying this action. Now, if we start, it depends on your time frame. You start to look back into a monthly chart. There's no damage done here. So, let's put things into context. But we also need to we're going to look back at March 2020 as well, because there's some very big similarities here. But now the timing of this, 4 billion December futures contract they put on the market was actually dwarfed by, at best estimate, probably from garnering, speaking to most of the desks I spoke to in Europe, probably 8 to 10 billion of unallocated long spot gold over the counter positions that was sold at market into thin overnight vapor thin conditions. Now, while this unregulated over the counter market action was the actual driver and unreported by any media, of course, it translated into the Comex $90 waterfall, which was reported and was too obvious for it not to have been officially sanctioned. So obviously that is a reportable market. Now the fat finger trial balloon floated by the World Gold Council, actually that should embarrass the heck out of them. How could you even propose that might have been an issue? Look, these were surgical sales that had already pre-calculated where the largest over-the-counter and Comex long stops as well, but mostly over-the-counter, where they were aggregated in this 10 times larger spot FX gold market, and with no other bearish crosses, nothing else that could have possibly attempted to attack the bid stack that was fairly stable after non-farm payrolls, which is already discounted. what the officials did was instigate a classic foreign exchange market intervention. There is no other way of describing this. And that created an air pocket by simultaneous bid pulling and using the air pocket that created. Bear in mind that we're talking about these are the market makers that make this market. And bearing in mind that not just the BIS gold desk at work here, but it's also the agent banks who have gold accounts at the Bank of England. There is no doubt this had to be orchestrated. And so basically what they had to do there was essentially create this air pocket, pull some bids, use this air pocket to buy dollars and square off this unallocated foreign exchange gold positions, but at a massive discount. Now, really, what we're saying here is that it's no coincidence that they precisely hit the very largest layers of long stops and short covered just as competing central bank and sovereign physical demand was awakened to jump on this discount. Now, I spoke to two major desks who had millions of ounces of silver and gold hit on the nose at the same level before it bounced. These were targeted. These stops were targeted, and we're talking about second-tier banks here and very large trading desks, all of whom pretty much share information and know roughly where. They're all aggregated at similar levels. Nobody expected a $90 move down in gold. I mean, that was outrageous, but there's more to it than that. So really, what happened, this short covering really came in just as central bank and sovereign physical demand was really jumping on this discount. Now, wholesale market footprints evidence competing central banks and sovereign demand, which ironically rescued the EFP, the exchange for physicals. You remember that's what blew up in March 2020, and this caused massive hundreds of millions of losses for the banks. Ironically, it was the central bank and sovereign demand that came in that rescued the EFPs from fractioning in March 2020 conditions, but it came very close. Now, what is not reported is that under the covers, the exchange for physicals, the EFPs, came close to mirroring the EFP blow-up, and as we witnessed in March 2020. In fact, these at-market sell orders hit in vapor-thin holiday market conditions, which we just said. Most European desks are on skeleton staffs. Actually, Japan and Singapore were on holiday. And look at the hour of the day too. It was the little observed, less liquid but deliverable October contract, which is what most people are not seeing. It was the contango there, much like we saw in March 2020. We saw up to $100 contango in the futures market versus spot, expanded momentarily to $48, with the bid-ask spot spread widening to around the same level. Now that is because the liquidity providers ran for cover. And essentially because most of these positions, the long gold positions held by others, they didn't want to deliver those, and it was like deja vu. But this time, officials were ready to manage the EFPs. They're not stupid. These traders know what they're doing, but not before the October contract was capitalized on at an $8.25 backwardated discount to spot. And it will be demanded for delivery in very large size. You watch out for the October deliveries. This is going to force insiders and officials to also buy physical to back up any remaining residual positions not already covered and squared into this surgical rinse. Now, this raid has forced a full spec capitulation. And any remaining sell orders are really now naked short momentum sales, which sets up really a perfect base for a rally from the 1677.90 December low. The December contract printed that low after this $90-odd smackdown. Now this low, let's put this into perspective, is exactly $227 higher than the 1450.90 March 2020 low, with the EFP between December and spot widening. The December contract actually widened to 675, so even that would have been capitalized on. But it's the October contract, which people swarmed into the October contract at this 825 discount, and it's a front month. It's actually, even though it's the less liquid contract, it's deliverable. The Comex is a deliverable market. Let's not forget that they're Basel III compliant and has to be physically demanded. Now, we already heard on Friday, after the non-farm payrolls headline beat that really caused the first of this capitulation move, that we already heard that our second-tier banks in Switzerland were already all over this October contract. And look, these guys are hedged. They're not stupid. And so really, what this does is it really sets up a gold for a very similar $600 physically driven rally into this BIS compliance, into the Basel III compliance into the end of the year. Now, Swiss desks that we deal with, have said, we're locking this in the October contract for size, and did again on Monday. Now, it's the same. This is hedged positions. Look, same in silver, except volume was actually minuscule. Now, if anyone wants to look at how rigged a market can be, there was only 7,800 lots that went on sale. Now, look, usually volumes of that size would move silver futures by around 25 to 30 cents. Look, we trade in those kind of volumes on a regular basis, but not $2. I mean, that is ludicrous. And so really, obviously, these lots were immediately jumped on. This sets up a silver rally. Look, if we look at the March 2020 lows as well, the 22,295 low is about $10.30 higher than the $12 March 2020 low. And really with an expectation of a similar scale, $18 rally or thereabouts into 35 to 40.
Andrew, you just mentioned that what we witnessed this week was directly related to Basel III. Can you just elaborate for everyone?
Yeah, Shane. With the Basel III window closing fast, unbacked gold derivatives need to be squared or backed with physical gold before NSFR standards are implemented on the 1st of January 2022. And as we discussed in our last episode, there are one of two options available to holders of derivative gold positions. Either they source the physical gold to one-to-one back up any remaining embedded derivative positions, or they have to square up these bilaterally settled over-the-counter liabilities before they roll onto their balance sheets. Now, both are happening, and it's the specs who are losing as the insiders are gaining. That's how it always has worked. Now, in order of scale, these unregulated unbacked derivative positions comprise really of plain vanilla foreign exchange longs and shorts. And so really, anyone that trades, when we see the FX market trade, it's around 15 trillion a year. But as we have highlighted before, these 15 trillion are categorized and benchmarked by the current LPMCL clearing process as physical. Now, that has been the problem. And this so-called physical is currently allowed to back up and hedge Comex shorts. And the Comex is deliverable. And that's alongside bilaterally settled forwards, options, leases, swaps, and loans. So, but at best estimate, if you look at the entire picture, this expands total derivative exposure to at least 70 trillion. It is absolutely unequivocal that it has to be those kind of volumes. Now, look, clearly both exit strategies that we've outlined are currently in play here, backing physical and squaring contracts. However, given the scale of the paper to physical imbalance, and that this exit strategy first involves selling the benchmark to all 70 trillion of derivative exposure, the benchmark being the FX price, this involves squaring up the long gold leg of a long gold, short dollar foreign exchange cross, and it means buying back the dollar. That explains the action. And that's precisely what we've witnessed. And given the degree of position concentration, it was clearly immune from regulatory oversight and officially sanctioned. It had to be. The Friday to Monday raid had the effect of wrong-footing a sufficient volume of speculators to affect this week's pre-planned short-covering mandate. And of course, this is largely at SPEC's expense. Now, notably, none of the crosses against gold or silver had moved sufficiently to warrant the targeted official intervention.
Andrew, where do you see gold and silver trading now?
Shane, let's take a look at short, medium and long-term picture. I think that's what people want to understand. You've got people that trade a 1 minute chart, 10-minute chart. You've got people who trade weeklies, dailies, monthlies, etc. So let's have a look short term. And as we discussed in our last episode, very, very short term, and especially now after the current bout of chart painting, we must expect some continued short-term volatility, but the weight of overhead paper market supply is actually rapidly reducing. You have to remember that. The last thing insiders and officials want to do is expand their derivative positions, which they're just trying to cover right now. And it's quite the opposite. If one looks closely, following the large short covering debacle, there's no other word for it, they are largely utilizing bid pulling efforts, not short selling, bid pulling efforts to trigger spec selling, into which they continue to cover off very large, unallocated, unbacked derivative gold positions into specs tricked into selling rallies into chart painted technicals. Now, while technical traders call for lower prices, as they did in March 2020, before it rallied $600 and $18 in silver, obviously, we then need to look at the physical demand versus the remaining paper supply, which we did at that time. And we think a March 2020 type low is in. Now, the structure suggests the low-hanging stops are already rinsed out, so there is no traction, no real traction to be gained to attack the Monday lows. These long stops are already gone. Very few people have come back in. In fact, the easy money's been made. And now we're evidencing the opposite. Specs taking the short load, which loads the upside for short cover for insiders to take the long side of every short. And what do you think they're going to do on the upside? They're going to cover into those stops. So that's the game. So then we move on to medium term. We're looking at short, medium and long term. Medium term, so if you're a medium term trader, stacker, then in simple terms, as we evidence paper market liquidity contracting, short term is going to create the sort of volatile air pockets that we evidenced this week. I don't think to that degree anymore, but however, with all the other jurisdictions, including the Comex, already NSFR compliant, this deleveraging process has become a delicate balancing act. And so in summary, in the race to exit the unallocated contracts before the end of the year, insiders are constrained as to the degree they can dare to put deliverable Comex gold futures into backwardation and into competing central bank demand. And I think they have definitely overcooked it. And this week's, when we look at the October contract, that's going to be expensive. This week's activity did put both December GC gold futures and SI futures into actionable backwardation, as well as the October contract. So, we even see silver for the first time since March 2020 in actual backwardation. Usually there's a contango. We discussed why, is because when you ship stuff out from around globally, when you average the shipping costs, say from Russia, from places that all over the world into a vault that's within 150 miles of New York, you're talking what, 12, 18, possibly 20 cent premiums. And when you see, so really there's always a contango. We're always very suspicious when that contango slips below 8 to 12 cents, because basically that means that they're losing money. And so really when you now see actually silver futures in backwardation, it's because the specs have jumped in and they're short selling this thing. And it's become a joke. This whole thing has become a joke. It's going to be very, very well. There are going to be some very wealthy insiders. Also, for you stackers, what's to lose? I mean, at these kind of prices, really, when you think about it, you're not in the market to. This is not financial advice. What I'm saying is, if you're not in the market to trade, and you're trying to accrue silver for the future, as a hedge against the dollar, where's the problem at this price? I mean, you know, in a few weeks we're going to bring on somebody who is deep in the mining sector and really understands silver, and how he's intimated on a conversation today that really things are beginning to dry up. The easy stuff's been gone. You know, there's going to be, so we'll bring that on. That's a treat for another time. But essentially, this is a hugely actionable price. So therefore, what we're saying, to offset physical delivery obligations, which would quickly offset the rich short covering pickings already gained, we also anticipate a rally off the lows soon. And as I say, last time, if you look back at a daily chart from March 2020, it took 3 to 4 full sessions for the algos to settle after the 1450.90 March 2020 EFB spike low. Now, it may take a couple more sessions for the rally to get strong legs. However, there are 2 bullish drivers that have to be factored in. The first one, paper market liquidity, open interest in gold, has contracted by over 300,000 contracts since March 2020. The other difference is that the Comex has now become a deliverable market, which is why some desks are not waiting, especially given the Monday overnight October 825 discount is hedged and going to be demanded for physical delivery. This is going to force some discipline on the insiders earlier than was seen in March. So really, we're recording this on Wednesday. Similar in silver futures, where open interest has contracted to about 150,000 contracts. It took 4 full sessions for the technical algos to settle that into physical flows and the momentum sellers to be overcome. That's what we're witnessing at this point. It is quite volatile, but you can see what's happening. And that opened up a very large physically driven rally, as we just mentioned. Now, while we've observed the key market-making banks on the Comex have sneakily shifted their trading into London under the radar, some trickery is still possible, and that is indeed how this was instigated. But even this morning, on Wednesday, momentums are still selling the rally and continue to provide short covering fuel for officials and agent insiders to cover a little more into. But looking at the deeply underwater options structure and the large central bank sovereign physical buying tripped off this week below 1800, and we see these lines crossing bullishly soon, and regardless of a strong dollar, gold and silver to start to migrate back up to their respective 1810 and 26.2 sweet spots. So then the final thing we said we'd look at is the long term. Now, this is the big picture. This is why our clients are stacking. This is why you should be stacking. Basel III seeks to address the collapse of US dollar hegemony, and the BIS really recognizes that gold is the only weapon that can unseat the dollar. And while the US, Russia and China are flirting with this dangerous military war, which is escalating on a day-to-day basis, the battleground is the war on US dollar hegemony. That's the key issue here. Now, the only solution other than obviously an unthinkable nuclear war, which is what we talked about the last 2 times, this is the only other option, is for the US to cash settle central bank rehypothecated bullion loans and leases and move to back the BIS-owned US dollar denominated gold positions. Bear in mind, this is the BIS has US dollar denominated gold positions and they need to back that with physical gold in the FX market before Russia and China disclose their real physical holding. Yes, the BIS has gold denominated in other currencies, but it's primarily in the dollar. So you can see why they're trying to do this. Now we've been covering short, medium and long term effects of Basel III, and we now look beyond January 2022, which then opens up the next phase, the implementation of Basel IV, which we're going to cover this more in the next few weeks, but it will be exponentially more bullish for a strong gold price and its related, well, obviously it's related dollar price, because really the gold isn't moving, the price isn't moving. It's the dollar, the more dollars it costs to purchase that ounce of gold. Now, by the time Basel IV is implemented on the 1st of January 2023, the Bank of International Settlements will have already revalued gold, and it will be on the long side in its efforts to maintain US dollar hegemony against military enemies such as Russia and China, and increasingly the BRICS countries, who already have strong affiliations with physical gold.
Hey, Andrew, wait a second here. You just mentioned Basel IV, and that's kind of frightening. Can you elaborate on this and tell us what the heck does this mean?
Yeah, Shane, yeah, absolutely. Basel IV. Look, I'm only going to touch on this today. I've got much fuller explanation coming up soon. But in essence, under the guise of ensuring banks don't fail again, and this is a guise, Basel IV is a globalist attempt to break the banks. This will be affected by recategorizing loans to businesses as high risk. That's a huge issue. And that's sufficient to cripple the credit capacity of all global banks, making business loans and mortgages actually almost impossible to obtain. That is, if you read Basel IV, that is what it aims to do. And that in turn will severely cut the credit capacity of all of the 60 plus BIS compliant global banks and increase their capital requirements to really unsustainable levels. Now, bottom line, this is the precursor to eliminating small businesses, driving in mega corporations who will become the employers, and ultimately introduce a universal credit system where ownership of any asset is deemed to be unnecessary. There can be no other explanation for doing that. In our last episode, we looked at how when Basel III was first agreed in 2013, it had already driven global gold market repatriations, central bank buying. Basel IV has also influenced these moves. However, we now see this accelerating, and while global bankers try to argue against the imposition of these draconian bank-breaking regulations, and the bankers are not happy about this, Russia and China have already broken rank and are leading the pack of BRICS countries to repatriate gold as well as exchange dollars for gold as fast as possible. This is going to accelerate. However, there is a massive European pushback as well against Basel IV proposals, and it is the Fed that's attempting to drive the Basel Committee to implement these draconian globalist policies. Now, one of my first-tier bank contacts says that likely Brexit was a pushback against Basel IV, one of the main components for wanting to implement Brexit. And we think that Basel IV will ultimately see a rift develop between the US and the BIS. This is a really interesting situation. Ultimately, when the BIS has fully secured physical gold as a currency, it makes sense for them to move away from the dollar and employ their strong gold position on the global stage. Russia and China will be embraced by Europe while the US stands against them. So really, we've got, when you look at who's pushing this and who's trying to defend it, clearly this is maybe short term the BIS wants to play ball and protect US dollar hegemony, but ultimately the BIS wants to run with gold as its own currency. I don't think the US is on board with that. And this puts pay really to attempt to confiscate gold or make it illegal to own as much, things like cryptocurrencies. They become global. So has gold ownership. I mean, as we discussed before, the BIS has no choice but to eliminate physical draining gold capping efforts and quickly move to revalue gold. And very short term, until they've secured gold as a currency, it suits them to assist in maintaining this US dollar hegemony. So really, as we wind up here, much like Basel III did under the LBMA, until the LBMA bragging letter came out, there was no mainstream media attention to it. Basel IV now flies under the mainstream media radar, and it will continue to do so. This is a massive upcoming bullish driver for gold, and current action completely eliminates or hides the upcoming forced revaluation move. I'm going to update much more on Basel IV very, very soon.
Well, there you have it. Another episode of Live from the Vault. I certainly know that you enjoyed this episode as much as I did. Awesome stuff. Now, buy physical. I guess that's the underlying principle here. Buy physical. And thank you so much, Andy. And that's all we have for you today here from Live from the Vault. Be sure to help us spread the word by sharing this channel, by liking it, by hit that subscribe button immediately, and then go ahead and click that bell. You'll get notified. So with that, leave your comments below, and we read all the comments and questions. So thank you very much, and we'll see you next time on Live from the Vault. Bye for now.